What happens when a company gets paid before it has delivered the product or service? In this video, I explain why deferred revenue shows up as a liability on the balance sheet and introduce common transactions that lead to this recognition in a variety of industries. In the previous video, I introduced 5 steps that the company must follow to recognize revenue. In a customer contract that has multiple performance obligations, the firm must track whether they have satisfied a certain performance obligation and only recognize the revenue when it is actually done. So what happens if the customer has already done the payment before the work has been completed? Here we have a common situation where the payment has been received either because it's a deposit or because of part of the customer relationship, but the work is not yet done. So it's very important for us to make sure that we do not recognize revenue on the receipt of the cash, because under the accrual methodology of accounting, we get to record the revenue in the future period when we actually do the work. In the meantime, when you have received the payment from the customer, you're going to recognize it as a liability on the balance sheet. So the most common language is deferred liability. It was a little bit more common to use the terms unearned liability previously. We don't see it. Accordance to the new guidance, that's not a language that is typically used. However, we do see a couple of different terminology nuances that I'm going to show you in just a couple of slides. This liability reflects the assets that you have received. Very often it is cash. It doesn't need to be cash. You could have received other assets for product or services that you are going to deliver in the future. So what the company records at the moment that the payment is received, if we think about our balance sheet and income statement framework, on the income statement, there's no effect, but on the balance sheet, we're going to increase cash if we're receiving cash or increase another asset if we're paid in another fashion. And on the liability side, we're going to create an increase to a deferred liability. In the future, when the work is done, that's when we have the impact on the income statement. The sales get recorded. Of course, that's a profit increasing transaction. I am ignoring here any considerations of cost and inventory. We're only focusing on the sales side right now. And of course, anytime we have a profit increase, we increase our retained earnings for that financial period, and the liability goes away as well. So all we're doing is essentially delaying the recognition of the sales. There's an intermediary step. If we have a disconnect between when the payment occurred and when the work is being performed, for now, the value of that payment is going to hang out as a liability on the balance sheet. Is this line item going to be separately disclosed on the balance sheet, or is it going to be rolled together with some other items? That depends on materiality. If the line item is big enough, it will be disclosed separately, and that's going to be specific to every given company, kind of relative to their size, relative what's important to them. It is very often going to be a current liability, but if you have a situation where the work to the customer is not expected to be completed for 12 months or longer in the future, it could be a long-term liability. So here's an example. Accenture, which is a consulting firm, they have a very large amount of deferred revenue in current liabilities. This is $6 billion. However, they also, in addition to that, have a portion in non-current liabilities, $642 million, because a portion of is going to extend beyond that 12 months mark. And again, for Accenture, this is quite normal. They have very long-term relationships with the customers. Sometimes the payment from the customer comes in the beginning in a bigger amount. So a lot of times it's kind of a little bit of front-loaded situation. So they make sure to accurately reflect the timeline of the work. When are they expecting to be able to convert this into revenue within the next fiscal cycle or not? As I mentioned in the introductory series of videos, it is sometimes difficult for us to put millions in perspective. Is this a lot for this company? Is this little for this company? So here, if we think about this deferred revenue, the total amount of current and non-current as a percentage of total assets, it's 10%, which is actually pretty sizable. So it makes sense that they're highlighting it as a standalone item on the balance sheet. In the footnotes, they give us more disclosure on their revenue recognition principles. They specify that when they receive the payment before they have done the work, they recognize deferred revenue. Another word for it is contract liability. So here they're kind of giving us a synonym for this, contract liabilities. And they also specify that the revenue is actually recorded as the work progresses in accordance with agreed upon contractual terms, either at periodic intervals or achievement of specific milestones. So I will talk about this more in a video in a couple of weeks in terms of How do you determine whether the revenue should be recognized when you have a long-term project where there's kind of a continuity of work as opposed to a specific items being delivered at a specific time? Here I have an example of two retail firms, Home Depot and Bath and Body Works. Both of them within current liabilities have a deferred revenue. For Home Depot, it is a line item. It is $2.5 billion, which for them is 2.5% of assets. For Bath and Body Works, it's actually a smaller dollar amount in terms of millions, but it is a smaller company, so it is bigger in terms of the percentage of the assets. They do not disclose it separately on the balance sheet line item, but we can find in the footnotes that this amount is included in a kind of catch-all account called total accrued expenses and other. Why would a retail firm have deferred revenue? We normally think about just coming in, buying the products that we need, and then walking out. And a big part of the answer are gift cards. So if you're a retail firm, typically you sell gift cards. Gift card is the cash payment from a customer for work that has not been done by definition. Work will be done when someone comes in and buys something, and instead of paying cash, actually uses the gift card. So all of the companies that sell the gift cards will track this deferred revenue liability. Let's go for a second to the disclosure. So if we go to the 10K of Home Depot, on the revenue side, they recognize revenue at the time the customer takes possession of the merchandise. So again, for most of the products, this is fairly straightforward. It's literally at the counter sale. However, here they highlight that in addition to gift cards, they do have other things. They have installations, service programs. They have sometimes things that are pre-ordered. So they do have situations where they receive the payment before the customer has taken possession of the merchandise or before the service has been performed. They have gift cards as well, and that's included in deferred revenue also. Let's jump to Bath and Body Works. The company records deferred revenue when cash payment is received before the transfer of control or goods. That primarily relates to gift cards. However, they do also have loyalty points and rewards and direct channel shipments. So they have other situations as well where the payment occurs before the work is done. If you're just learning accounting, you may have noticed that it's a little bit like a foreign language. When you start, there's a lot of terminology that is unfamiliar to you. As you use it more and more, you start to get more familiar. You start to understand what things mean. You need to continue to learn that foreign language. Sometimes there is industry-specific or company-specific language for the same items. So for example, for Hanover Insurance Group, on the balance sheet, we don't see a reference to deferred revenue or unearned revenue, but we do see reference to unearned premiums of $3.4 billion, so it's fairly large. Footnotes indicates that this is the unexpired portion of the premiums. This is primarily how they do the business, right? So you make a payment to the insurance company. When do they provide a service to you? As time goes on. In the videos on adjusting entries, I talk about several of such examples. For American Airlines on the balance sheet, again, we don't have anything that sounds like deferred revenue, but we do actually have air traffic liability for $7 billion. And on top of that, we have loyalty program liability, and that one has a current component and a non-current liabilities component, and those are whopping also $3.7 billion. So air traffic liability is the deferred revenue that literally relates to the flights. When you purchase American airline flight, you make a payment in advance. They get to recognize revenue as they carry out the flights. So that is deferred revenue. It's just labeled a little bit different. Loyalty program liability is deferred revenue. It's because on a variety of transactions, both as you make the flights, but also if they have associated credit cards, they have kind of associated other ways for you to earn the loyalty, the reward points. And these are very popular. Airline loyalty reward points are possibly the most popular ones out there. So every time that you buy a ticket, not only are you buying a ticket for that flight, but you're buying a quarter of the future flight that you're going to take. So the company needs to make sure to track that. They have quite a large amount of disclosure in their 10K because it's a big number. In relative terms, this is almost 30% of the total assets, these three liabilities combined. So here we see that their significant contract liabilities are loyalty program mileage credits that can be redeemed for future air travel, non-air travel, and other rewards. They talk a little bit about how they evaluate them, the fact that there's fluctuations based on seasonal patterns, how likely these are to be redeemed, when, etc. So whether any of them will be expired. What do we learn from looking at the deferred revenue disclosures? First of all, we have a better understanding of what type of relationship the firm has with their customers. Do they have long-term service relationships? Do they have subscriptions and memberships, which tend to be quite predictable in terms of continuity? Do they have customer advances and deposits? So again, there's a high degree of predictability of continuance of that particular transaction. Do they have gift cards, loyalty, reward points? So all of that information we see from both the existence, the amount, and the related disclosure for deferred revenues. It is often useful to look at the changes in the deferred revenues. They tend to be the harbinger of the changes in revenue. So if you see an increase in deferred revenue during the period, that means from a variety of these relationships with customers, the firm is able to generate more sales that they haven't done yet, but the customers have already made the payments. So typically what that means is that the increase in revenue are going to come in the future. This understanding of the changes of future revenue is really important to market participants. And deferred revenue is going to help with that, but it's actually not going to give us a complete picture, because don't forget, if you have customer orders that you have signed, but they didn't come with a prepayment, they didn't come with any advance, then these are not going to show up as a deferred revenue. However, they typically are going to be disclosed, and this is something that we call backlog. Backlog is the disclosure about customer orders, whether paid or not. A lot of times they are unpaid, that are going to provide additional useful information. If you go back to the video on balance sheet transactions, I talk a little bit about backlog and I show some examples of real firm disclosures about backlog as well. The final point that I want to introduce here is the idea of breakage. When you have a deferred liability because the customer has paid you, but you haven't done the work, there are situations where you don't actually expect to fully complete the work. So for example, in the case of gift cards, maybe you have an understanding that some of the gift cards will expire. In the case of other relationships, loyalty programs, maybe some of those expire before they're being used. Maybe you have a situation with customers where typically you're dealing with small businesses or restaurants, and sometimes you know that 10% of them go out of business before there is a chance for you to actually do your job. If that is the situation, you are allowed to recognize breakage, meaning to move some of this liability to recognize as revenue before you actually do the work, because of the estimation that there is a portion of the work that you will never have to do. Here's an example of disclosure. For Build-A-Bear, they talk about the fact that unredeemed gift cards, also known as breakage revenue, is recorded in proportion to their redemption patterns. So they don't tell us exactly what they use as an estimate for gift card non-redeemability, but they do talk about sensitivity. If they changed their gift card breakage estimation rate by 1 percentage point, that would have resulted in a change in revenue of $1.1 million. So their total revenues are $496 million for the year. So this is not a huge number, but they are highlighting that there is this estimate of gift card breakage, which is embedded as part of the $496 million. Marriott talks about the fact that they also have a breakage that is estimated based on their loyalty programs. So they're saying here that 1% decrease in the breakage estimate would increase the liability of $50 million. And again, so they're anticipating that not every point that is earned is going to be able to be used. So every time that a customer earns point during every period, when they look at the number of points that have been earned, they're saying, we know that 5% or 10% or whatever will never be used up. So we don't need for them to actually manifest themselves as a work performed. We get to recognize them sooner based on these breakage assumptions. That was a discussion of deferred revenue liability. How does it get created? When does it go away? What are the assumptions that come into play when we're talking about it? I hope you enjoyed the video. Please like, subscribe, tell your colleagues and friends, and I'll see you in the next one.